In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at E.L.F Beauty. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For E.L.F Beauty this is -5% for the trailing 12 months. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see, E.L.F Beauty have not improved their free cash flow as it is -36%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Their revenue has increased by a solid 9%. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value has improved by a decent 8%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are great at 12 and 17%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. Unfortunately, it would take them about 7.5 years to pay off the debt. At present, with the information we have gathered, it tells us that E.L.F Beauty's key pillars are looking okay, but let's find out more. Tap the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. Now we will focus on other key pillars which help define an excellent business. So let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently at 71%, which is superb, as we like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is 12% and is slightly below our target of 14%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 0.64% this looks quite poor, and explains why it will take about 7.5 years to pay off the debt. As we are potential shareholders, we will now want to look at the average book value growth for the last few years. This is 18%, with the lowest point being this year at 8%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is amazing 94%. But for this year it is -4%. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures. Looking at the chart, we can see that in 2019, E.L.F Beauty was trading at about $17 per share. They were slowly trading higher, but in 2022, they began a rapid increase. Then dipped, as the market had dipped, at the end of 2023, but rapidly regained that momentum until July of 2024. They have now dropped to the levels previously seen this time last year, about $108. We can see the current market cap is $6.10 billion. They are currently generating $1.13 billion in revenue. Their net income is $122.24 million. And they have 56.39 million shares outstanding. At present, their earnings per share tells us that for each share of stock, the company earned $2.10 of profit. And the current P ratio is 51.57, which suggests the company is a lot higher than the S&P 500, which has a PE of about 27. With the overall consensus being a strong buy. On average, the analysts believe that the price target should be about $187. It is also predicted that their sales growth will continue to grow over the next few years by about 25% a year. Now I am going to show you how to create a valuation. I will use the current earnings per share of 2.1 cents. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give E.L.F Beauty a 25% growth rate. Then, I am going to give them an estimated PE ratio of 30. After that, I will project these numbers forward by 10 years. I then want to receive a 15% return from my investment. This then gives me an estimated future stock price of about $587 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $145. Then we apply a margin of safety. At 25% it gives me a buy price of about $109. It all depends on your personal view and outlook for the company, as well as the return on the investment you would like to see. Please consider sharing this video with someone you think will like it, and click on the link above to learn how to create your own earnings per share growth model. The return we would receive if we bought at our 25% margin of safety price of $109 and sold in 10 years' time at our estimated future stock price of $587 would be 439%. But this is dependent on our assumptions for the company being correct. In addition, they don't provide a dividend. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, E.L.F Beauty scored 6.5 out of 12. For this, I will give them a cross. As for the past results, over the last few years their share price has been going up, but has taken a significant dip recently. Therefore, I will give them a check. Analysts are signaling E.L.F Beauty is a strong buy, and predict they will grow on average about 25%. Here they gain a check. Using the EPS growth model I used earlier on, we created a buy price of about $109. Therefore, I will give the valuation a check. According to Morningstar, E.L.F Beauty don't have a moat. So, I will give them a cross. My final overall rating is 3 out of 5 stars. I have given this a category B rating within my own stock watch list. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.